Good afternoon. Welcome back to Money Control's live stream. You're watching Closing Bell with me, Lovisha Darad, and joining me, my colleague Yatin Mota. Well, quite a volatile day for the markets, as we expected, since it was the monthly expiry day as well. We saw markets starting in the green throughout 1 o'clock. It was, floating in the green as well. However, after 1 o'clock, we saw some profit booking, and then towards again the last 30 minutes, we again rebounded back and settled in the green as well. So eventually, Sensex settled with about 200 points gain, and Nifty is also above that 23,200 mark. The weakness that came in from the broader indices, where we saw that the mid-caps, saw a bit of a, flat in the red, and however, on the small cap front, that was flat in the green at this point of time. So mixed cues coming in from the mid-cap and small caps front as well. Among sectoral indices, Nifty IT and Nifty Auto index, that were the top sectoral laggards. However, Pharma index, that outperformed and that did well in today's trading session. With this, the January series has become the fourth straight series of decline for the Nifty, and January alone saw Nifty see more than 2.5% cut, and the past four series has seen Nifty declining by in double digits, over 100% cut coming in. Yatin, February series is usually a weak one, and with budget as a key event, the mood is likely to be keenly watched out for as well.
Absolutely, the budget event as well as today's expiry clearly relating some volatility there. If you talk about the markets, were stable since the morning. Second half saw some volatility, and eventually we turned to red when it comes to the markets post lunch. However, in the last 30 minutes of trade, we had a 100-point spike on the Nifty, and probably that is the reason why we were able to close around that 23,250 mark. Nifty Bank also gaining 150 points. However, small and mid cap stocks continue to underperform, almost a flat kind of a close for both of these indices. However, the market breadth remains better. Almost 3 stocks advancing for 2 stocks declining. Sectorally, real estate, energy, pharma stocks doing well. IT and mid-cap stocks witnessing some bit of selling pressure. Overall, a good day of trade, Lovisha, with focus largely on select budget-related stocks as well as earning stocks.
Let's take a look at some of the key Nifty 50 gainers as well. Bharat Electronics topping the charts, about 4% gains coming in for BEL. Great set of numbers. It was beat on all parameters, and the street is rewarded the same for Bharat Electronics as well. Hero MotoCorp with a 2.5% gain coming in, rising for the third straight session. Power Grid also coming in with more than 2.5% gains. The company will be rolling out its Q3 scorecard on February 3rd as well. Cipla also seeing a gain of about 2%, extending its gains to the third day as well. Q3 earnings remains beat, and management also expects to end the FY25 exceeding the margin guidance. However, if you look at on the contrary side of the Nifty 50, we can see Tata Motors. She saw a sharp fall of about 7%, and it is topping the Nifty 50 losers chart as well. This came after a Q3 net profit saw a sharp fall of about 22% year on year on weak demand, and even the JLR segment is facing headwinds in the Chinese market. On the other hand, Adani Enterprises, more than nearly 3% cut coming in for Adani Enterprises. A weak Q3 set of numbers, profit fell sharply by about 97% year on year. Shriram Finance, profit booking after 2 days of surge, we could see. Bajaj Finserv seeing a cut of about 2.5%. Modest Q3 profit is up about 3% year on year, and revenue was up about 10% year on year. Adani Ports also seeing a cut of nearly 2% after Q3 earnings missed estimates. So that is all for the Nifty 50 gainers and losers. But Yatin, why don't you take us through mid-cap gainers and losers?
Yeah. So, if you talk about the F&O stocks, we had stocks like Laurus Laboratories as well as, Divi's Lab recovering in trade. Obviously, you saw the, US authorizing, emergency vaccines as well as medicines to be disbursed, because of which the stocks saw some recovery, especially to do with the Laurus Labs ARV business, which will probably benefit from this move. 6% higher for that stock. KPIT Technologies continues to move after yesterday's guidance increase. Yesterday's stock saw almost 8% gains today, also almost 6% higher for that one. SRF, post the numbers, was doing well in trade, almost 6% higher for that stock. What did not do well in the F&O space as well as the mid-cap space was Voltas, down 15% post numbers, after the unitary cooling product business saw some margin decline along with the engineering business, which saw both revenue downtick as well as margin downtick. Tata Motors, disappointing guidance for JLR on the A return on capital employed front, stock was down 8%. Obviously, the demand in China is moderating, especially electric vehicles also are looking at some slower, overall adoption. ABB post their parent declared numbers and the orders from India slowed, had a sentimental impact. That stock also fell nearly 6% in trade.
All right. So without much further ado, let's quickly get on board with our market expert, Mayuresh Joshi of Market Smith India. Mayuresh, good afternoon. So good to have you. Mayuresh, do you believe that most of the negatives is already getting priced and the bulk of volatility is done? We are down with major events. Fed is done. Donald Trump's comeback is also, we are going through it. Earnings is also going on. Do you believe that budget could offer some better recovery for the markets from here on?
Afternoon. I think a large element of how earnings have played out, the remainder part of the earnings season, the expectation broadly is earnings might remain soft and therefore downgrades around the corner and some element of recovery as far as earnings is concerned only happening in the first half of the financial year or the next financial year. Having said that, the expectations in terms of how the global geopolitics plays out and how inflationary data points stand out, both from a global and a domestic context, will guide the rate cycle as well. And a large part of the market believes that if core inflation is expected to remain sticky, rate cycle or rate cuts might be delayed or deferred. Having said that, the expectation again in terms of Trump's policy making, what probably happens in terms of the US debt itself, do they wind down treasuries, and if they do, what kind of an implied effect does that happen on bonds and bond yields in general? And does that create some element of upheaval as far as the global equity markets are concerned? I think both all these elements, there is still expectation that
Okay.
Mayuresh, good to have you on the show. Yatin joining from the Mumbai studios. Obviously, the budget is slated in the next 2 days. Expectation is that the government will, tightly look at the fiscal deficit portion, which is targeted around almost 4.5% for FY26. However, one number that the market will be looking for is the capex spending. This year, probably we won't be able to meet the projected capex guidance. But would you, concur that from Q4 onwards, we could see PSU capex and government spending picking up, and hence growth and earnings would also see some silver lining? Or probably you think things will be slightly slower than anticipated earlier?
Afternoon, Yatin. So I think again, as you rightly pointed out, I think the capex spends had been lower this year for a platitude of reasons. I think you had monsoons, you had elections, and therefore I think the spending has been deferred. But to a large extent, again, a large part of the market believes that the 11.1 lakh crore outlay in the last budgeted figure should show significant increase as we head into the next budget. And these spending targets will probably bring back micro earnings back. So again, a base case scenario laid out yet in that quarter 1 of the next financial year, you should start seeing some element of earnings coming back into the markets.
Okay. Some earnings. Mayuresh, so far the FM hasn't done a lot for the middle class. Do you expect
that you're probably seeing some tailwind coming through in terms of more disposable income in households and families, and therefore more spending coming through and consumption probably also coming back. So yeah, expectation is that there should be some relief coming through.
Okay.
Mayuresh, right now the market participants that you talk, are now talking about capital protection. The return expectation also of the market participants has been slightly lower. In such a scenario, what do you think sectors would do from here? Do you think pharma, IT, the defensive sectors would probably see overall inflows from institutions because, there is some margin of safety there? Or would you probably be a contrarian buy into some growth sectors?
No, so I think Yatin is going to be a mix of all this that we probably go through. So I think over the next few months, interestingly, I think as government capex accelerates, as we have been speaking, I think a large part of the investment-driven pool, specifically into capital assets, will start picking up steam. And that's the hope, that private capex at some point of time comes back. And if that happens, you're probably expected to see some pockets of infrastructure stroke manufacturing, where a lot of impetus will be given in terms of domestic industries, domestic growth, some PLI schemes announced as well. I think that can be a value addition and a value creator as well. Defensives typically have done well. IT has been a stark outperformer. Valuations a tad bit on the higher side, late stage basis, as we see it in markets in India. But selectively, I think within IT and pharma, you'll have to be very, very stock specific in these spaces. But again, I think a few of the domestic cyclical themes, a few of the rural focused themes might continue doing well. Rural consumption is expected to come back. Rural discretionary spending expected to come back. And with this as a base case scenario, I think a few of the agrochemical companies, a few of the farm equipment manufacturers, a few of the component manufacturers, including auto ads, selectively might do well. And again, I think to support the entire ecosystem, select banks will continue doing well. Expectation largely is the credit deposit growth should start matching each other, which means deposit growth should come back. Other parameters probably in line with estimations and expected to probably remain very, very steady. And because of steady state earnings expected, select banks probably might be this way.
Okay. Mayuresh, you were talking about capex increasing and of course consumption as a basket to be benefiting. But how do you expect the investors to approach the urban discretionary plays, like for example the Zomato or even Trend, or even if we look like Swiggy and all of that, because they've seen a decent correction from the highs as well.
So again, I think certain pockets of urban consumption are still doing well. It's not that the entire portion of urban consumption has been written off. And therefore, I think if you're looking at discretionary players like a Swiggy or Zomato, obviously post Zomato's numbers, they've obviously accelerated the expectation of store counts and pulled back a year. So I think they're going to 2,000 odd stores by 26. I think it's a strategy that they probably deployed to probably ensure that competition either moves with them or they move so fast in the next few quarters that competition might not catch up with them. If they are not able to open up the same stores with the same zest and the same speed that they're probably deploying. Obviously, they've got cash at their BS with the QIP and the cash on books of almost 19,800 crores. They are planning to open 2,000 odd dark stores by the end of 26, which was earlier targeted at 27. And therefore, the management is absolutely right. I think if you look at the cohorts in terms of new stores that are open, the contribution margin is negative 8 or 9%. And therefore, losses might continue, which had improved significantly, which might typically mean that Swiggy might also go down the path at some point of time to counter what Zomato has been doing. And therefore, this feeds into cash flows actually turning negative, which had turned positive. Obviously, how 27 plays out at a different ball game altogether. But the next few quarters is going to be a cash flow drain for both these companies. So I think I'll wait my time on for both of them.
Okay, all right. Mayuresh, just one last question before we let you go. Do you believe that, given that this earnings season has been, quite neither on the positive nor the negative side, do you believe that the less EPS downgrades could give some market confidence that, we could see some recovery from March or even April onwards?
I think that's the hope. And the hope again is that there is some element of stability that one sees post Q3 is over as far as Q4 numbers are concerned. And if that is exhibited over the next few weeks and months, both in terms of the macro data points that we are capturing, expectations in terms of some stability in terms of the global geopolitics and the global geo-economic scenarios out there, and if Q4 is then expected to be a quarter which is stable quarter on quarter, there is a large part of expectation, as I said, that quarter one of the next financial year is where you can probably assume that the worst in terms of earnings might be behind us. And you probably should see some element of earnings upswing starting to come.
All right, with that, we have to let you go, Mayuresh. But thank you so much for your time and taking our time for that, talking to us.
Thank you.
Thanks, Mayuresh.
All right, with that, we've come to an end of this edition of The Closing Bell. As usual, we will be watching out for Q3 earnings tomorrow as well. We have some big names like Sun Pharma, IndusInd Bank, Nestle and ONGC, which will be coming out with its Q3 scorecard. But for now, it's a wrap from Yatin and me. Thank you for watching.